Hey there, it's Justin Van Riper with Real Estate Investing STL, and I'm here today to show you how you can purchase rental properties with little or potentially even no money out of pocket. So, how does it work? What we're going to do is purchase and rehab the property with cash or a hard money loan. So, we are not going to use traditional financing. I've got cash here in quotation marks, and I'm going to get to that in a minute and explain how that can be done in various ways. I will also explain how a hard money loan works. But the important thing to realize right here is that we're not using traditional financing. So after we rehab it, then we're going to rent the property out. Then we will refinance into that long-term traditional financing. And then you're going to repeat, of course, after that. So the 20% down myth, so traditional lenders are going to tell you that on a purchase, you're going to need to put at least 20% down for an investment property, something that's not your primary residence. So if you're buying, a property that's $100,000, that's going to require you to come up with at least $20,000 out of pocket. Now, if you're looking to, scale this and do 5 or 10 or 20, then that 20% down can, really add up quickly. So what do we do to get around the down payment issue so we don't have to come up with that 20% down? Well, since we are not purchasing with a traditional loan, we are purchasing either with cash or a hard money loan. Now, the long-term lender or traditional lender sees this as a refinance and not a purchase. So they don't require that 20% down anymore. So that's the important takeaway, is that this is now a refinance and it's not a purchase loan. So at this point, now they're going to be looking at the current value of the property. So it's been rehabbed, it's been rented, it's stabilized now. So now the lender is going to look at that current value of what the property is worth. And they will finance up to 75% of the new appraised value on a cash out refi. So they'll go all the way up to 75%, and they don't look at, there's no down payment requirements at this point. So the key is to find these properties that you can purchase and rehab for less than 75% of what's called ARV, which stands for after repair value. So that's what the property is going to be worth after you fix it up. So just as a quick example, let's say that you have a property that is going to be worth $100,000 after it's fixed up. Well, that means that you want to be all into that property, your purchased and your rehab, for $75,000 or less. That would allow you to basically get into the property for little or no money out of pocket. So what options do we have for funding? So I, said cash. I had it in quotations because there's a few different ways you can do this. The important thing to realize is that cash is king. So hard money is an option, and it's still a good option. But cash is always just going to be easier. You're a lot of times able to get lower offers accepted if you're using cash versus hard money, because you can close quicker. There's no financing contingencies, stuff like that. So a lot of times you can just get better deals, and it's just a much smoother transaction. So cash is definitely king, but hard money is still an option. So where can you find this cash? So of course it could just be money that you have in a checkings or savings account. That's pretty basic. But it also could be a home equity line of credit or a HELOC. So typically a HELOC, they will go up to 90% of what your home is worth, your primary residence. So if you're living in a home that is worth $200,000 and you only owe $100,000 on it, so the HELOC will go up to 90% of what it's worth. So 90% of 200,000 is 180,000. Then you subtract what you owe from that 100,000, and now you're left with $80,000. So you could get a HELOC or a home equity line of credit for up to $80,000. And HELOCs have they're very easy to use. They essentially work just like cash. You can take the funds after you've been approved for it. You can use them very easily. You don't get charged on the interest if you're not using it, if it's just sitting in the account. But then once you go to fund a real estate transaction, then they'll charge some interest on it, but it's still very low. But it's a really, really good option for a lot of people to use. So if you have equity in your primary residence, a HELOC is a fantastic strategy that you can use. Another one, maybe you just have money tied up in the stock market right now. That's money that you could use to fund your real estate deals. And keep in mind with any of these options, the funds that you're going to be using, it's all going to be very temporary. So you're going to use these funds to purchase and quickly rehab the property, get it rented out, and then you're going to refinance, and that cash out refinance will pay all of that money back. So, if you take, say, in that HELOC example that I gave you, so if you take that $80,000 HELOC that you took out and use it to purchase a property, once you go to refinance, as long as you're at 75% or better of ARV, then you will get that $80,000 directly back to you. So that's how you end up purchasing the property with essentially no money out of pocket, because the money that you did put into it, you get all of it back once you refinance. So another option too is self-directed IRA. So if you have a retirement account, you can always check with your employer to see if it's an option to do self-directed IRA. That's also a fantastic strategy. Real estate is one of the things that you can invest in a self-directed IRA. I don't have time to go into all of the details, but if you have a retirement account, you could put that into a self-directed IRA and be able to use those funds to invest in real estate. And then, of course, you've got family and friends. So maybe none of these options work for you, but you have a family member or friend that has some equity in their house. They've lived there for a while, or maybe they just bought it for a great deal. They bought it with cash. They've got plenty of equity in their home, or they've got a retirement account, or they've got money in the stock market. Those are always people that you could partner with, or you could also get a private money loan through, which is going to be one of our next options. So cash is king, but there are a few different loans that you can do that are still much better than traditional financing. And these loans are going to be asset based, based on the value of the property. And both of these will also allow you to get away from that 20% down payment. So hard money loan, it's short-term financing. It typically does have a high interest rate. You'll have to pay points on it typically. Each hard money lender is going to be different, but they are pretty expensive. That's why they are meant to be just short-term. So you might have it anywhere from 3 to 6 months before you refinance into that long-term fixed financing with lower rates. And as I mentioned, the loan is primarily based on the value of the property. A private money loan, that's very similar to hard money loan, but you can even have terms that are more flexible and can be negotiated easier. So maybe if you have that friend or family member, or just someone that that could help you fund these deals, you could always approach them with the idea of loaning you some money through a private money loan. So I want to go through an example of one that we actually did. So this was a 4-family property. The sales price was $68,000. The rehab cost was $30,000. It appraised for $130,000. So we were right at 75% of ARV, which makes it. Remember, ARV is the after repair value. So after we did the rehab to it, after the $30,000 was put into it, it now is going to be worth $130,000. So we're right at that 75% mark, which is what we're looking for. The monthly rent was also going to be about $2,200 for this one. So I just went through quick rental projections. So you've got a yearly gross rent of 26,400. Then you're subtracting 10% out for management, 10% for maintenance and vacancies. Then you're subtracting out your taxes and your insurance. And then also your estimated mortgage. You're going to have a mortgage on the property at this point, and you're left with a net operating income. And of course, this is an estimation, but you're left with a net operating income of over $14,000 per year that you're getting in rental income. So what does this look like, let's say, in 30 years? So if we're getting a little over $14,000 in just cash flow per year, so that's going to bring in $425,000, give or take, over the course of 30 years from just cash flow alone. Now, if the property appreciates at just 3%, which is on the low end of what real estate typically appreciates at, that same property now is worth $315,000. So after 30 years, you also have this property 100% paid off. So you have a property that's worth $315,000 that is free and clear. So if you choose to sell the property at this point, you'd be pocketing everything because you're not having to pay off a mortgage. So you're left with $315,000, and then you've brought in $425,000 in cash flow over the 30 years. So you could have a profit from one property of over $740,000 from just one. And the crazy thing about this is that you bought it with cash or a hard money loan and then refinanced out so that you got all of your funds back out of it. So you had no money out of pocket into this deal. So you produced this asset that brought you in $740,000 over a 30-year period, and you did it with no money out of pocket. You got all of your money back out after you refinanced. So it cost you nothing to do this. So what do we provide? So we provide properties that are going to fit this model. Properties that are going to be at 75% of ARV or lower, and then are going to cash flow well. So those are the two things that we look at. Are the cash flow possibilities, and then we want to be at 75% or better of ARV. Now, most of these properties are in the St. Louis area, but we're very, very experienced with working with out-of-state investors, have done it many times before, and we can provide referrals for short-term lenders, for hard money if you go that route. Remember that cash is always king. If you've got a way to do cash, whether it's through a HELOC or self-directed IRA or anything like that, that's going to be ideal. But if you use hard money, it's still fine, still a good option. But can provide referrals for hard money lenders, for the long-term traditional lenders, for contractors, for property management companies, for basically anything that you would need to be successful. We can go ahead and provide referrals for that. So what are the next steps? So if you or someone if they qualify for this, then I'd love to talk. So call me or text me directly. At that number right there. And then just a quick summary is that you can create up to $740,000 in profit from each and every property that you buy over the course of a 30-year period. And the crazy thing is that you can buy these properties with little or potentially even no money out of pocket. You also get to invest passively. And one thing that I didn't even discuss here is there's also tax benefits to owning real estate, such as depreciation. So you get tax benefits from it as well. I'm not going to go into that too much, but that's another added bonus, is that you also get tax breaks as well. And then, of course, we will provide everything that you need. So the properties that are going to fit this model, and then referrals for the lenders, contractors, property management companies, anything that you might need. So I'm just going to go back to this screen one more time. So if this is something that you might be interested in, then please reach out to me directly, and I would love to talk to you. Thank you and have a great day.